bottom line is you don't have to refinance. You don't have to wait the 6 or 7 years for the amortization schedule to work its way. You can get that new appraisal done. The key there is, and the thing that I want people to understand is, you have to go through them. You have to initiate the process, and you want to tell them you would like to initiate the process to have a new appraisal done for the purposes of removing PMI.
Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today I have a special guest, Mr. Jeff Chisum from SDRHomeFinancing.com. Jeff, how you doing today?
Yeah, I'm doing great. Thanks for having me, Ryan.
So, Jeff, can you give listeners to the podcast a little bit about your background and experience?
Yeah, no, absolutely. So, been in the business since 2008. So I'm a survivor of getting in when the big crash happened. So definitely had to figure out a way to survive in the business. And, since then have ridden the roller coaster that the mortgage business has gone through. But 16 years in the business originating, have my own team, which is important. Not trying to do this all on my own, but about 2020, bought my first short-term rental. And prior to that, had come across some information around the 10% down second home occupancy loan, where Fannie and Freddie had made some significant changes to their policy that were really designed to keep people from thinking they were operating in this gray area, that they were buying this property that everyone fully was aware that, most people were going to rent out on a short-term basis. And Fannie changed their policy so that, it was more inviting for people to utilize that property in that way and not feel like they were committing mortgage fraud. So ended up using that product for myself. And then once I got into, these different networking circles, found out that there was a lot of misinformation around that product and a lot of people didn't know about it. And they were working with loan officers that primarily did deals for people that were buying primary residences, so they weren't familiar with the policy or the product either. So really found a huge opportunity to educate people about the product, about the opportunity, and in turn, just really made it more possible and feasible for people to enter the asset class. So it's really developed into a place where for probably about the past 3 years, this has been 100% of my business is helping clients with the financing to buy vacation homes / short-term rentals.
Yeah, I remember when I first started buying real estate, typically like multifamily or smaller units. And it was always kind of that thing that got swept under the rug because a lot of realtors, a lot of lenders, sometimes everybody knew that the person was using the FHA or the owner occupied loan for a rental. And it was just kind of like this little thing that you didn't tell anybody. But it was nice to see that for short-term rentals. I remember in 2020, you had 100% bonus depreciation, 10% down secondary home loan that was vetted, right? And you're able to rent it out. And it was the best thing since sliced bread, because especially for the tax side of things, you were able to buy with, let's say you bought a $500,000 home, 10% down, you're in at $50,000 without closing costs. But yet you're writing off $120,000 against your income. And it's like the government was funding 70 to 80% of the purchase price in the form of tax savings back in 2020 and 2021. And it was amazing for investors. Honestly, it was amazing.
Yeah, absolutely. And, it has been my experience that that's kind of an afterthought for people. But right. Definitely something that I tell people you should be very aware of, very educated on. And, that's where you've done a great job of just educating people about that opportunity in this asset class.
So talk a little bit about like the different types of loan products that you've seen or used or that you guys use the most common. Is it that 10% down secondary home loan and kind of what is the qualifications look like if I want to use, am I able to use projected rental income, or how does all that work?
Yeah. So 90% of my business is clients using that 10% down second home occupancy loan. So it's a fully qualifying, we're going to use your documentable income, whether that's your W-2, your tax return. So, the strongest borrower typically is going to be your W-2 wage earner, because Fannie loves that income. There's a debt to income ratio standard that you have to meet. So it's your gross qualifying income up against your debt load obligations to creditors. It's all factored and calculated on your monthly ability to support that debt, and that's what the ratio is based on. But then, to answer your question about projected income, you have to be able to absorb that PITI payment, principal, interest, taxes, and insurance payment for the property without consideration that this property is going to generate income. So you cannot use any type of projected income or market data towards your qualifying income on that product.
Mm-hmm. And so it's unlike a multifamily, or if you have like an investment loan where you're able to use the projected rent to help you qualify. And so then instead you're basically looking at just your W-2 or your business income on whether or not you're able to qualify for that mortgage payment. So do you find that people kind of, how do people get stuck? Because I've definitely come across people where they buy one or two properties, they kind of they max out their debt to income, and then they feel stuck, right? Because they can't borrow any more money. What does that look like in terms of how long they own those properties to when they're able to start buying again, essentially?
Yeah. So, it's until your income can catch up and put you back into that 10% down second home occupancy lane. So, you can potentially do 10 of those. Fannie Freddie will allow you to have 10 mortgages in your name. There's nothing to say that all 10 of those weren't originated as a second home occupancy loan. So, yeah, it's your ability to be under that debt to income ratio standard. So, let's say you bought two in, whatever time frame, you were under that debt to income ratio standard on the two, but now you're up against the ceiling. So it may be that you are able to show enough income from those properties to put you back into that lane. So what that would look like is we only need 1 year of Schedule E income on your tax return to be able to use it towards your qualifying income. So you don't have to wait 2 years. Now you may have a stronger number after 2 years, but you only have to have 1 year of that Schedule E income. And we don't have to count the accelerated depreciation against that calculation. So it's not going to hurt your calculation. But otherwise, if you want to scale faster than that, we're typically going to go to the DSCR loan in today's environment.
Mm-hmm. And one of the things we were kind of talking about is how the different types of loan products as a buyer will make it more of a competitive offer. Have you had, what's kind of been the experience? Because I know firsthand as somebody who's selling a property. I actually had a property for sale earlier this year. We had 7 offers in 3 days, and my realtor called me. She goes like, "Oh, we got 7 offers. Here's the 4 offers." And I was like, "Oh, okay. What about the other 3? Oh, those are FHA or VA or small money down offers. We're just going to kind of throw those away." What's kind of the pros and cons of these different types of loan products?
Well, I mean, if you're in a destination type area, realtors are going to be accustomed to seeing that 10% down second home occupancy loan used. So it's not as of a big deal as if you're buying in, maybe a metropolis area where, they are seeing deals come through where people are buying them as their primary residence. So that could be a drawback. Also in these destination areas, a lot of these realtors are familiar with the DSCR loan, so they know how it works. They know how it operates. Now, if I can get on the phone with them, which I highly suggest to the borrower and the buyer's agent, once you submit the offer, let me know so I can get on the phone with them. That way, if there's anything that they're not aware of as far as the product or things that I might be able to educate them on, gives me that opportunity to let them know, hey, they are using an investor loan. This is all that we do. We've already run the analytics, the data to show that we're not going to have a problem getting an approval, which I can't guarantee one, but we've done a lot of these deals and we've got a lot of experience, and I wouldn't issue a pre-approval letter if I didn't feel confident that this borrower couldn't complete the financing. So it's just giving them the assurance, having that conversation. But, one of the things about DSCR loans is a lot of lenders and brokers are not delegated on these products. So they have to send out the file to the investor to have it reviewed, to, sign off on the funding, on the closing document. So each step of the way, the loan officer's having to send the file out for the investor to review it. So if I'm a listing agent, one of the things I'm going to ask is, hey, where do you lose control of this process? Are you delegated each step of the way? And if I hear no, I'm going to have some reservations advising my seller to go with this deal on this investor loan, because the lender basically is going to come to a point, probably several steps of the way, where, they're going to have to say, yeah, we hadn't heard back. We sent it off a couple of days. We're waiting. You never want to be the lender that has to say we're waiting. So that's a big deal on, any product, but especially the DSCR, because it's more common that the lender's not delegated. So difference between delegated and non-delegated is delegated. The investor said, hey, we trust you with each step of the way. You can process the loan. You can underwrite the loan. You can close the loan and fund the loan. Non-delegated is you've got to send that off to be reviewed each step of the way by the investor.
Wow. I didn't even know that. And how does experience play in a role into that? Because I feel like as a seller, if I get an offer from somebody that has done 4 or 5 DSCR loans, and I'm going to feel more confident that they're going to be able to get the deal done versus somebody that hasn't ever done a investment loan or a DSCR loan before, right?
Right. Yeah. I mean, that's like the podiatrist doing brain surgery. You don't want to be the patient that they're experimenting on, that they don't have any experience, because it can get a lot of people in a lot of trouble fast. If they don't know what they're talking about, they don't know what they're doing, they haven't been through the process to get a deal done. So experience definitely matters. Having that delegated control definitely matters.
Yeah, and that's just not about real estate, folks. That's everything. I think
what CPA. That's exactly right. Yeah,
I see. Yeah, I see. Everybody always kind of comments. My wife and I just moved to this new town, and we just joined the local Facebook group, and it's every single comment or post in the group is looking for a reliable, great, cheap contractor or plumber or electrician or whatever. And I just always got to remind these people, it's like, you can get, the price is what you pay. The, value is different, right? Because I can go find a doctor to do open heart surgery for $5,000, but it's his first open heart surgery. Right. But if I want the guy that's done hundreds of them and is taught in school and wrote books on how to do it, I might be paying $30,000 for that open heart surgery. It's like you can get, price is what you pay, value is what you get. And I think that's with real estate investors, we're always trying to watch our bottom line and make sure that profits are up. But there's definitely some things that you don't want to cheap out on. And I think anything financial, lenders, realtors, CPAs, attorneys, investors are always, so not always, but sometimes trying to get the lowest cost option. And I would caution against that.
Yeah, absolutely. There's one route that could potentially save you some money, but also it could cost you a lot of money. And then, there's the other option that could cost you money up front, but it's going to make you a whole lot more money in the long run or keep you out of trouble.
So something came across my desk last week, and it was a message from you. And you said, hey, I got something interesting. I think you and your audience would love to hear about this. And it's regarding PMI, private mortgage insurance. And so I know somebody that's dealt with PMI before. I think one of the biggest mistakes that I made when I bought my first property was I bought a FHA, owner occupied, 3.5% down. And what I didn't know is that once you do hit that 20% in equity and you have FHA and a PMI, that you have to get an appraisal done, and you have to refinance in order to drop the PMI. Had I gone a conventional loan, 5% down, and got my 20% equity, I could have just gotten an appraisal done, and they would have dropped the PMI without me having to refinance. That's a huge mistake that I made that I wish I didn't, because to refinance now would not make any sense, because my loan is at 3%. If I refinance today, it would be at 7%, and I'd have to pay for an appraisal and all that. But you have an idea, or no, is it an idea? It's not an idea. It's a factual piece of evidence that a lot of people don't know about how to drop PMI. Can you talk a little bit about how exactly we can go about doing that?
Yeah, no, and I'm glad that you brought the FHA up, because a lot of people don't know. Once in an FHA loan, you're married to the PMI until you get out of the loan, which is refinancing or you sell the house. So, I think we're all kind of guilty as lenders that we don't get into the nuances of some of the, certain aspects of the loan, like PMI. It's kind of one of those things where, it's there. We don't really get into the details of how do you get rid of it, because most people are going to just kind of assume, well, I pay the loan down based on the original purchase price through the amortization schedule. After about 7 years, roughly, I hit that mark where I'm at the 80% loan to value. The PMI is going to drop off. Great. I paid my dues. I paid my PMI to the man. And if people don't know what PMI is, which I'm going to throw that out there, it doesn't benefit anyone but the investor. So it's there in the case where if there's a default on the loan, any losses are going to be paid by that private mortgage insurance policy. So you're basically paying a policy that's going to protect the investor, Fannie and Freddie, for the most part. So, yeah, I really thought we're thinking about cash flow. How are we saving money? Insurance is going up. And, a lot of people see PMI as a bad thing. Now, PMI affords you the opportunity to put less than 20% down. So there's some benefit there in that you're not having to come up with as much cash. PMI typically, for most of my clients who have really good credit on a 10% down second home loan, is going to be about 0.23% to 0.28% of the loan amount. So you multiply the loan amount by 0.25%, you divide it by 12, that's your monthly PMI amount that you're going to pay. So, it's $100 a month or so on most average deals. So it's a cost. It's a cost of doing business in this space. So, yeah, I had this idea of, this information potentially could improve people's cash flow position. And especially for the people that bought like in 2020, 2021, and they've got that 3.5% rate. And maybe they're thinking, well, gosh, the only way I can get rid of this PMI is to refinance, or I've got to wait, for 3 or 4 more years for it to drop off. That I could provide this information, and maybe they could get out of it sooner than they thought. So I'm just going to go down the line and tell you what the policy is. And anyone that wants this information and these loan lookup tools that I'm going to refer to, we definitely can get that information out whether they reach out to me directly or you put it in the show notes. But first of all, you want to establish whether you have a Fannie Mae or Freddie Mac loan. So these are their policies. They apply to their loans that they hold on their books. So you go to the Fannie Mae or Freddie Mac loan lookup tool, you put your name, address, loan number, and it tells you, yes, you have a Fannie Mae loan. If it says no, you jump over to the Freddie Mac loan lookup tool and look it up that way. Or sometimes you can see it on your credit report, or it may say on your monthly statement. But those are the easy ways. Jump on their websites and look it up. So you establish you have your Fannie Mae or Freddie Mac loan. Then you jump over to the associated policy. So I'm going to go over Fannie Mae real quick. So if you've got a loan that's secured by a one unit principal residence or second home, so that's the way that the loan was originated, then you have a loan that was originated within 2 to 5 years, or within the past 2 to 5 years, you can get a new appraisal done. And as long as you show, based on the new appraised value, that your loan to value is at 75% or less, then you're eligible to have that PMI removed. If it's 5 years or less, 5 years or more, greater than 5 years, then you only have to show a loan to value of 80%. So the big one is, so you jumped into a property, and we want to make these properties stand out. We want to maximize the opportunity. So we went in, we put our 10% down, and then right off the bat, we remodeled the kitchen, the bathroom, maybe you added square footage. You did significant improvements to the property. Your potential, and with that, you increase the value of the property. You're eligible to have that PMI removed if it's less than 2 years, and only have an 80% loan to value because you put significant improvements into the property.
Yeah. And so I think the biggest thing behind all this is that it doesn't require a refinance in order to drop PMI. So if you had a favorable interest rate, which most of us did in 2021, pretty much like up into what was it, like the fall of 2022, I think is when rates, it was actually like right after the wealth conference, I think.
Yeah.
June or something, 2022, where rates just, started going up. I think they were like in the low to mid fives, and then they just started skyrocketing. But the big thing here is that there's ways to drop PMI, which most people who are in secondary home, like you call them destination areas, that bought pre-2022 should easily have that in equity now. Just because of how many other people have been coming in and buying properties in that area, driving up the value of the homes, right?
Yeah, that's exactly right. So bottom line is you don't have to refinance. You don't have to wait the 6 or 7 years for the amortization schedule to work its way. You can get that new appraisal done. And so kind of what that process looks like, because I just went through it myself on the property that we bought in 2021, is you go through your servicer. So who you're making your mortgage payment to on a monthly basis. You want to get to their insurance department. You want to get to the mortgage insurance department, and you want to tell them that you would like to initiate the process to have a new appraisal done for the purposes of removing PMI. So the key there is, and the thing that I want people to understand is, I don't want you to hear this podcast and go, oh, great, we'll call an appraiser, we'll get an appraisal done, send it to our servicer. You have to go through them. You have to initiate the process. And then they're going to do typically not a full appraisal. That may look differently, but you're going to pay anywhere from $150 to $200 for them to go through the process to get the new appraisal. So you call them, tell them you want to initiate it. They're going to do an analysis. So they're basically going to tell you, hey, we're going to send you an email that does all the calculations. So based on your current principal balance, the new appraisal needs to come back at this amount at the very least to achieve this loan to value. And then you have to arrange for the payment to be made for the new appraisal, for them to do the new appraisal.
Yeah, and I think that's the important part. Is it's not an appraisal; it's a broker opinion. You called it.
Yeah, BPO.
I had never heard of what that was until you brought it up. So thanks for that. Hey, a quick question. So I've heard that there's differences when you're going to apply for a new loan. I've heard there's differences in whether or not you had a Fannie or a Freddie in the past and how that Fannie or Freddie counts against you debt to income wise. Do you know anything about that, or am I crazy?
I can't think of a scenario where it would affect you, whether it was Fannie or Freddie. Now, they do have their own nuances when it comes to their underwriting guidelines.
Maybe that's what it is.
Yeah, so it could be that loan, whether the lender goes through Fannie or Freddie, could be a difference maker in how they look at assets or how they calculate certain things. So yeah, it's important that the lender know the different kind of nuances in your kind of specific scenario.
And what are some kind of, I guess, current trends or anything that you are noticing within the last couple of months that you wanted to talk about?
I mean, we're seeing, a lot more opportunities for acquisitions just to get into deals just because of the rate environment. So people are not having to do the crazy things that they were proposing in order to make themselves more attractive on a deal. So waiving inspections and appraisal contingencies, all those escape clauses and contracts that are designed to, be safeguards if, things didn't work out during the contract period. So it's nice, that people aren't having to take that risk. Seeing, the environment is supporting that people are buyers are able to ask for things. So seller concessions. So that definitely helps in, this environment we're in where, there's not a ton of options when it comes to, not paying points. So there's typically going to be some level of cost associated with locking in a product. Well, on the 10% down second home occupancy loan, for example, the Fannie and Freddie will allow for 6% in seller concessions. So, we're seeing where buyers are being able to ask for things. So that's nice as well. So it helps people keep money in their pocket. So it's definitely. It's nice to see more of a balanced trend where it's not a seller's market. We're seeing buyers are able to get into deals easier.
I mean, that's great because the people that are still penciling out deals are going to be able to enter into a market where, the interest rates are higher than what we've had in the past couple of years. But if you're able to buy something now, there's going to be way less competition now compared to down the road when if interest rates tick down, you're going to have more buyers entering in that market. And not only are you likely to pay a higher price, you're going to have more competition. You're going to have to start waiving those contingencies again. And it's just like a pendulum, like it just keeps swinging back and forth, back and forth. But you mentioned the seller concessions. I think that was one of the biggest. I'm so glad I learned about that when I bought my first house, is because a lot of people think that, here's this house that's listed for $300. I'm gonna go buy it for $280 or $285 and call it a win, right? But a seasoned investor knows, hey, if I can lock this property down for $290, I know it's going to appraise for $300 or $310. I can go back to the seller and bump up the purchase price a little bit and say, hey, I know we're on a contract for $290. I got an appraisal in hand here. They'll cover up to $300,000. let's bump the purchase price up to 300. You give me $5,000 as a credit and you get to keep the other 5,000, and I'm happy, you're happy, the bank's still happy, and everybody wins. But a inexperienced investor would have just said, oh, wow, now my net worth goes up by an extra 10 grand, maybe.
Yeah. And that's, you don't know what you don't know, but, hopefully you've built a team around you that does know. So we go back to the value of having an expert in your core on your team. That's where they can advise you on, some of those things, because you don't do deals every day that you may not have thought of looking at it in that way. So yeah, instead of, lowballing them 20,000 below their list price, what if we only go down, 10,000, but then we ask for 6% in seller concessions? So, you keep more money in their pocket. You don't offend them by a crazy low deal. And, there's ways to find ways to do deals where everybody wins. So yeah, but it takes people around you to advise you with the right information and maybe a different way of doing things than you knew about or have thought about doing.
Awesome. Where can listeners of the podcast find you, Jeff? Yeah,
so the easiest way to connect with me is to go through my website, strhomefinancing.com. It's the website is built to educate people on financing options. So we want to do that. We want to gather a little bit of information about what you're doing. Kind of that whole process and experience probably takes 15 minutes to go through the content and answer the questions. And it leads to being able to schedule a phone call. So, the goal is we get on that phone call. It's more about answering your questions versus you listening to me, educating you about products and, the process. So yeah, that's the best way to connect.
Thank you so much. I know I've implemented a similar model to yours, a huge education first model. It's paid dividends and awesome site. I just test drove it just now, guys. Great site. So check it out. Jeff, strhomefinancing.com. And thanks again.
Yeah. Happy to be here. Thank you.